Welcome to the Market Moment. This is Matt Walters here alongside Lee. Lee, how's it going?
Good.
Good weekend? Easter weekend?
Easter weekend was good. Weather was nice.
Yeah.
Time with family.
It's always a fun weekend. Today we're extremely excited. Very, very special guest, Stephania Aliaga from JP Morgan, Global Market Strategist on the call today. So we're just going to kind of jump into it so we get as much time with you and have as much time to hear your thoughts as possible. But Stephanie, welcome. And before we get started, if you don't mind just spending a minute or two just telling us a little bit about yourself, where you're from, where you went to school, how you got into the industry and started with JP Morgan, and just anything like that you want to share.
Absolutely. Hey guys, thanks for having me. My name is Stephania Aliaga. I'm a global market strategist for JP Morgan Asset Management. Our team here called Market Insights. So we're the team behind the guide to the markets. If some of you are familiar with that resource, our second quarter guide just came out yesterday.
Yeah.
A little background on me. I studied finance and economics at the Wharton Business School for undergrad, and then I've been really with JP Morgan for my entire career. I used to be on a trading desk, actually, pitching some of our tactical investment ideas to high net worth clients for a couple of years, and then had the opportunity to, I think, really dive into what was my first love in college, which was macro research, on this team, and I got to work under the guidance of David Kelly for many years as his research analyst. And so I've recently kind of spun out into to becoming my own strategist and developing my niche on talking about really the U.S. economy, markets, and lately a lot with AI as well. So Last year, really spending a lot of time thinking about what AI could mean for our long-term assumptions around the U.S. economy, productivity, labor markets. It all kind of came together in this white paper that we wrote. So that's kind of been a really rewarding and interesting project of mine.
Yeah, that's awesome. Yeah, AI is everywhere. So today it's good that we're actually talking to somebody who knows what they're talking about.
I was going to say,
everybody has their opinion on it, but
I think we've established in the first 5 minutes that she's smarter than both of us combined.
For sure.
So, we'll go ahead and get started. First question I want to throw out to you, Stephanie, is, last year was a good year in the markets, somewhat bifurcated, but it was a good year with the three major indices. And then we've gotten off to a great start with the first quarter of 24. What are your thoughts as we begin Q2 for the U.S. economy, the markets? What are y'all's thoughts as we get started here?
Absolutely. And it has been a really impressive run in the markets. There's no doubt about that. I think last year, the performance was pretty remarkable. I'd say a lot of that has to do with more of actually a recovery from the sell-off and a lot of those tech names that we experienced in 2022. Yeah. But the good times have continued this year, right? The first quarter of 2024 saw over 10% gains year to date in the S&P 500, which is a stellar return for a calendar year, let alone a quarterly one, right? And I'd say it's hard to be as bullish about the returns from here on out after 10% in a quarter than maybe we would have been on January 1st. But I would say the backdrop for risk assets and for the markets, broadly, it still looks pretty favorable right now. Yeah. You have an environment where the, economy is still doing really well. A recession does not seem to be in sight from the way that we're looking at the data. The Fed is now easing, and that removes this really great source of uncertainty and volatility that the markets have had to cope with over the last 2 years. Is how long and how far is the Fed going to be tightening policy? We're finally on the other side of that hill, which removes that huge kind of burden, I think, on markets. You also have this earnings recovery, and I think that's really the difference this year versus last year is where last year the Mag 7 just dominated market returns. Over 60% of the returns in the S&P were just those 7 companies in the index. This year, we're seeing that broadening out happen already. Now it's kind of flipped. You actually have 2/3 of the index is actually driven by the rest of the other 493 names. And a lot of that has to do with this earnings recovery, whereas last year you had earnings recession and all those other companies. This year, you're now seeing a lot of other areas of the markets returning to profitability, and that providing more durable support to the markets more broadly.
Yeah, and so, especially the beginning of last year was definitely AI driven. It was the AI story in the markets, and so if you think of very common baseball analogy and think of the AI story and where we're at, where do you think we are at in terms of what inning would you say that we're in? Are we still in the first inning? Like, are we still just getting started in kind of the bigger AI picture?
Yeah, I love the analogy. I think baseball season just kicked off, right?
Yeah, it did.
Is that you have the
Yeah.
inspiration behind that? So I'd say it's hard to tell. One thing to keep in mind is that markets have this tendency to overappreciate the near term when it comes to these like big, transformative technologies, the hot new topics, and underappreciate the long-term impacts.
Right.
And in the near term, I think a lot has been appreciated, definitely. But we are talking about a theme, I think, that will continue to be the theme for a decade. And I think we're still in the early innings of the actual adoption of this. But what we're finding is that, we might be at the beginning of, I love the analogy actually of the gold rush. Maybe you guys have heard of this,
Mm-hmm.
but, it's really hard to make money in the gold rush. But the companies that are sure to make huge profits are the guys selling the picks and the shovels.
Right.
And that's what we're seeing right now. The adoption of AI is still in its early innings, but the companies that are selling the chips that you're going to need, the cloud service platforms that you're going to need to even get started on onboarding this AI capabilities and technologies, those companies are already seeing billions and billions of dollars of profits. And they're early in the game. There's very little competition there. And we're still not really sure what the TAM, the total addressable market of AI and AI related technologies is going to be. And so we're kind of in this state of almost like the iPhone moment where we finally, we're realizing that this technology is going to be transformative. It's going to be massive. Every company, government, user is going to need to onboard this technology. But the overall scope and size, and I think a lot of the questions around the commercialization of this, we're still coming to terms with. Mm-hmm. So I'd say a lot has been appreciated in the markets, but it doesn't seem like the valuations have really gotten dislodged from just the actual the changes in actual earnings trajectory that we're seeing in these names so far.
Yeah, one of my, I don't know if concerns is the right way to say it, but with AI playing such a big part in the markets, in the equity markets, the impact that will have on the entire market moving forward, right? With Nvidia and AMD and some of those companies being a very cyclical business, right? It wouldn't be very surprising to me, anyways, to see Nvidia's earnings come down over the coming years, just because maybe of all of the forward demand that we've pulled forward, right? How many years worth of demand have we pulled forward into last year and this year? Do you see that as a major risk to the overall market? Let's say Nvidia started to, I think they're going to continue to grow and all of that, but maybe their earnings, we enter into a different stage of the cycle specific to that industry. Is that a concern for the overall market, or is that specific to those companies and those names?
Yeah, I think that is one of the concerns that comes with market concentration, is that any kind of slowdown, any contraction, even if it's mild, even if the fundamentals and everything are still rock solid, and AI is going to be this multi-year theme, and it's okay for adoption to just like take a little time, but will markets allow that? If that ends up being the guidance, is definitely could cause some volatility in the names. I'd say what our equity portfolio managers are seeing with NVIDIA is that over the next few quarters, it's very unlikely that there will be any major competitors to the kind of advantage and the moat that NVIDIA has on these semiconductor chips. But we are in this early stage of this technological cycle, and over time, we will have that greater economies of scale. We're already seeing a lot of the other, hyperscaler and mega cap tech companies explore options for, in-source manufacturing and provision of semiconductor chips to kind of get a bite of the apple. So I think competition will enter the market over time, but it's just really hard to say how long it will be and how far this one company could really run before that becomes taking a more meaningful chunk from its profit margins.
You may have addressed this in your white paper that you mentioned earlier, but where do you see AI impacting the average consumer? You know, if you ask, 10 people on the street, has your life been impacted by AI, or, do you interact with it? Most of them would probably say no. But how does the average consumer, or how will the average consumer, do you think, be impacted by artificial intelligence?
Yeah. And I'd say for that average consumer, there's probably a million ways that AI is already impacting their day to day that they're not even aware of. When they open social media and it just so happens that every ad is hyper targeted to what they were talking to their friends about over the weekend or what they were scrolling on, a couple days before, that's all AI. When you get a phone call and it just happens to know this call might be spam, that's AI and facial recognition software, et cetera. The real game changer and the reason why this has kind of taken us all, kind of captured all of our attention, is generative AI and the ability to now build upon decades of advancements in these large language models that can do all sorts of things when it comes to reading, writing, speech comprehension, and spit out completely new content in a way that is really, easy to understand, that is in our own natural language, that is in all of the different forms of mediums, right? The examples of how we're going to see this in our day-to-day are exponential. I think the ways consumers might notice it off the bat, it's going to be maybe that new video game that comes out that it's like, oh, this is AI, created, and it's like a whole nother level of virtual reality or whatever. Maybe those are the kind of flashy ways that we notice it. But in our paper, what we looked at is really what makes this technology so important for economists, really, and for all of us thinking about what are our assumptions for how the world is going to look like in 10 years. It's its ability to automate so much of what humans currently do right now. Mm-hmm. In our paper, we found that, and this kind of is aligned with a lot of the other existing research out there, about 1 in 4 tasks that make up the U.S. economy, all the things that we do every day in our daily jobs, seem exposed to automation. That is kind of a general goalpost, but that number can be as big as 60 to 70%, as little as 20%. But I think it just goes to the magnitude of the things that we do, whether it's summarizing information, reviewing forms for completion, things like processing an insurance claim or reviewing a whole body of literature. Those tasks are very ubiquitous across the U.S. economy. And if you can increase efficiency by a meaningful amount across all of those little tasks, that adds up to a pretty sizable productivity gain. We found that might be something like 1.7 to 2.4% per year over the next decade. That's really meaningful. And it's also not completely out of unforeseen, I guess, in terms of our own history, because that is a similar kind of productivity boom that came out of the internet era.
Right.
And so what we're looking at is something probably a similar magnitude, if not a little bit more. These things will take time, but I think overall this does make us more bullish around the potential for U.S. growth, which was really on this kind of more stagnant path before the really potential of this technology became into greater visibility.
Yeah. So pivoting from AI to a much more boring conversation related to the Fed and interest rates, and 23, we spent a lot of the year. I think you heard the big R word, recession, a lot coming into 23, and people were putting forecasts out there and saying when we were going to have, or were we already in one, and are we going to be in one soon? And you don't really hear a lot of that now. So what is your thought, and kind of where is JP Morgan at in terms of recession? Are we completely out of the woods, or is that still something that you guys are seriously looking at?
Yeah, I'll say the economy is never completely out of the woods of recession. In any given year, there's probably the 15% chance that we're in a recession. That's kind of the baseline, right? Mm-hmm. But I will say the economy does seem to be on stronger footing this year than we thought it was at this time last year. And there's really 2 big surprises. Like, a lot of economists got this wrong, I think, the amount of resilience that the economy has shown so far. One has to do with the consumer. I think the size of excess savings that were still circulating in the economy definitely surprised expectations. You had a lot more of it, and you also had it pretty well distributed across income quintiles. So it wasn't just the wealthy. You definitely have like the wealthier segments of consumers very well supported, but you also had that middle income consumer as well. And so that really providing this pretty meaningful support for consumption last year. And the consumer is the bedrock of the U.S. economy. It accounts for over 60% of the overall GDP. So if you have just even a bit stronger resilience in consumption, that can do a lot in terms of powering the overall economy, even if other areas are slowing down. You also had some one-off effects. I think business spending has also hung in there pretty well. Some of that has to do with this increased emphasis around AI and investing in AI-related equipment and technology. You also had this boost from, I think, the IRA last year, some pretty solid state and local government spending. But this year, when we kind of look forward, I think the other big surprise that suddenly everyone's talking about these days is actually the surprising boom in immigration that we're seeing. We have yes, a lot of, I think, frictions happening across the border, but regardless of that nature, the reality is that we have something like 3 million more workers in the economy today because of immigration, both legal and illegal. And the fact of the matter is those people are working. They're consuming, they're contributing to the economy. They probably are allowing us to sustain this elevated pace of job gains that we've had over the last 2 years without contributing to higher inflation. And that's key because now suddenly we can kind of appreciate good economic data, and it's no longer like good news is bad news.
Right.
I think that was kind of the limbo that we were in last year when it comes to economic data, whereas if the economy is doing well, we're overheating, the Fed's going to need to tighten more. Now we're seeing that the economy can actually sustain stronger growth while disinflation is still well on track. And that's kind of the environment that we're seeing it right now, where the economy is going to moderate this year relative to last year. Last year, we had a really strong 3.1% annualized growth in GDP. This year, we're probably going to get closer to that 2%. But 2% is still 2% above zero. It's still like well above water.
Right.
And we don't really see a high risk of recession now that it seems like we're on the other side of the hill when it comes to monetary tightening. Mm-hmm. And I'd say when it comes to the consumer, there's also just been this really healthy layer of immunity to higher interest rates. And that has to do with the fact that the majority of homeowners in the U.S. have fixed rate mortgages. Mm-hmm. And they fixed those rates during that long, almost like 10 years or so before the Fed started hiking rates, where interest rates were near 0%. And that layer of immunity, it's gradually fading, but it's fading very slowly. The average effective mortgage rate in the U.S. economy right now is 3.8%. That is only 0.5% above its historic low. Yeah. So that is still really helping shield consumers from the impact of higher interest rates and allowing for us to sustain other areas of growth in the U.S. economy without causing this inflation problem for the Fed.
Yeah, I think one of the dynamics, and we don't have to get into a lot of this, that's been really interesting to see, it has been housing price is the real estate market and how well home prices have held up relative to the increase in rates. I know there's a supply and demand issue that you see across the board there, but it's just been really interesting to see. If you would have said, "Hey, interest rates are going to go up 500%," what's going to happen to home prices? I probably would have said they're probably going to come down, a material amount. Yeah. And I know where we're at. Now, maybe there are markets where they have a little bit more, but across the board, I think they've held up pretty well, which has been, good in a lot of ways. It's made it really tough for first-time home buyers, right? Because now they're paying a much higher rate on the same priced home. But it's been really interesting to see, and something that I know everybody's keeping their eye on moving forward.
Yeah,
absolutely.
I've got two quick questions, and I know we're running short on time. J.P. Morgan's forecast for the rest of this year as regard to Fed rate cuts. What are y'all projecting?
Yeah, I'll say our view this year has really been to take the Fed at its word. And the Fed has signaled that they're looking at 3 rate cuts this year, beginning in June. And the continued commentary that we're hearing from Powell, really, and Powell, I think, is the most important voice to listen to when it comes to the guidance around the Fed. So I wouldn't get too worried about, Waller's comments last week and such. But that commentary has continued to really emphasize that disinflation is on track, they're comfortable with some of the fits and starts of inflation. Maybe it's a little hotter than expectations one month and the other month it's a little below. It still leaves them on track to cut rates about 3 times this year. And the important point on that I'll just say quickly is I think it's not so much that we're about to embark on Fed easing. We're embarking on monetary policy calibration. Inflation was once 9% year over year. We're at 3.2%. That's coming down to 2.5%, almost 2% by the end of this year. The Fed is saying they don't need interest rates at the max tightness that they've brought it this cycle anymore. They can begin to reduce the dial, reduce the tightness just a little bit to be better in line with where inflation currently is and the progress that's been made so far.
Do you think that we can get back to 2%?
On inflation?
Yes.
I think that, yes. I think 2 to 2.5% seems a bit more plausible. I appreciate some of the structural drivers of inflation that had kept inflation below 2% before the pandemic have probably changed. And there's now maybe some more upward structural drivers to inflation when it comes to deglobalization, some of the reassuring, the impact of technology suppressing inflation. We might see a return of that with AI, but that seems to have dissipated so far. So overall, I think we probably are living in this mildly hotter inflation environment, but 2 to 2.5% is okay.
Yeah.
And I think it really doesn't lead to any issues with the functioning of the U.S. economy, but maybe it does align with a federal funds rate that also settles at a higher rate than what prevailed before as well.
And we continue to hear, is a 2.5% or a 3% the new normal? And so I was just curious as to, your take on that.
And real quick, I want to get, the 2% has been a huge question mark for me of just like, where did that come from? And one of the jokes is, well, 1%'s too low and 3%'s too high, so they chose 2%. Yeah, exactly. Is there more behind it? You don't have to get into this in a lot of detail, but I assume there's a lot more behind it than what it just kind of sounds like the right number, or is it just kind of a gut, like, hey, this feels about right?
Yeah, it's kind of funny. There is really not much science behind it, but except for maybe art. I think the view is that slightly positive inflation is good for a well-functioning economy. You want prices gradually rising over time. It helps companies. It gives them companies pricing power, which can help support profit margins. It also incentivizes people to invest versus just save, because you're now losing some purchasing power from just keeping cash underneath the mattress. But the 2%, I think it all kind of really comes towards guidance. It's, once you pick a number, you stick by that. And you really find that credibility and that accountability around that number. And that credibility is what is most important for having a well-functioning economy that doesn't need to worry about, uncertainty when it comes to just inflation and price volatility.
Interesting.
Yeah.
I want to end with a question, and of course we've kind of teed you up a little bit. You've seen what we're going to talk about. You work for arguably, one of the most respected CEOs, in the country, if not the world. Jaime Dimon, his voice, carries a lot of respect when he speaks. And, he essentially called the bottom of the stock market back in March of 2020. His comments are heard around the world. And he made a statement, I think, late last year, that he felt like there was something that we needed to be concerned about, that, the economy was, headed towards something that wasn't that good. Is there something that we should be watching out for? Is there something that JP Morgan is concerned, or that we just need to be, cautious about as we continue into 24?
Yeah. So I think the one thing to remember on Jamie's comments is that he is the leader of this massive financial institution, right? Major bank, and he needs to be focused on business continuity under all sorts of scenarios, like really like stress testing the business under any kind of range. And so his views don't always necessarily align with the firm's kind of baseline view and projections for the state of the U.S. economy or interest rates. Right. But I think they definitely do underline that there are always risks on the horizon. I think right now, we have elections, not just in the U.S. but globally, and there's all sorts of maybe risks that can come from potential policy changes down the road. I think there's risk that comes from just market concentration in and of itself. But I think the biggest risks for portfolios are actually the kind that you can't forecast, that you can't well project and position for and hedge against, right? Those are omnipresent, as is market volatility in any given year being an investor, right? And your biggest protection against those risks, those unforeseen things that happen, that blow up in the middle of the night, is diversification. It's, looking at the weightings within your portfolio. Have you rebalanced after the strong gains in S&P 500 and in the growth in market concentration that we've seen over the last year and a half? If you're really spooked about U.S. elections or what's going to happen, with the U.S. debt, how much U.S. assets do you have in your portfolio? Do you have anything international? Like, what are you diversifying your exposure in some, in some ways? So I think we don't think right now is the time for investors to be positioned defensively. We still think the backdrop for risk assets is favorable as we see things right now. But it's not a cheap market either, and risks are always, on the horizon. So we think it's an environment where you want to be overweight active management, underweight cash, and then thinking prudently about some of those diversification opportunities that you can, protect your portfolios this year.
Yeah. Hey, and real quick, we got a comment on last week's show, and so I just wanted to ask you a quick question. This came from one of the viewers. They were talking about the price of food and how that, that impacts everybody, and how food has just gotten ridiculously expensive. Whether you go out to eat or go to the grocery store, it's just expensive. What could we expect? What could the average consumer, expect with food prices moving forward? Is that something that we, think could actually come down, or are we kind of at the new norm and we're just going to have to adjust and hope it doesn't keep increasing at the same rate?
Yeah. So I'll say it's one of those things where the price of our grocery bill is something that we intimately see, right? And it's something we remember what we used to pay for things
right.
a year or two ago. And it's something we are always constantly reminded of. And inflation in some areas of the economy paired with disinflation in other areas of the economy that we might not appreciate as much, right? We're gonna kind of focus more on where we're still seeing those price impacts. But I think what we're living in is just this era of sticker shock still, where inflation prices aren't rising to the same degree as they were a year or two ago, but we still see the prices are much higher now than what they used to be for a whole host of things. Mm-hmm. But people will probably be surprised that food inflation, I think, is only about 2% or below year over year. Mm-hmm. And that's coming down. Last month, it was at 0% month over month. And that we think is going to continue to come down, because one of the biggest things that impacts food inflation is energy inflation, and supply chains are now operating much more efficiently than they used to be, even before the pandemic, despite all the problems going on in the Red Sea. Yeah. So the drivers of food inflation do to us point to a much more benign environment for that. But I think it's just going to take time. It's going to take time for us to get more accustomed to the prices of things that we used to pay for. But we also shouldn't hope for deflation either. Sure. Deflation is the thing that depressions are made out of, right? So, over time, we're going to begin to feel, I think, the benefits of just wages rising in aggregate faster than inflation. Sure. And overall, we still have our job. We still have a growing economy and solid wage growth paired with disinflation. So all of that is going to make, the fact that our grocery bills are a bit higher than what they used to be, a bit more palatable.
Yeah, and I think, if you believe in the long-term averages, right, we went through a very long stretch where inflation was running at well below the long-term average. And so you just kind of have to expect there to be a period of time where it's running higher than just to get us back in line with, what the last 50, 60, 70 years have looked like. On an average basis. So, well, Stephanie, it's been awesome. We really appreciate you jumping on here and joining the show, and hopefully we can have you back on at some point. So,
thank you, Stephanie.
Awesome. Thank you, guys.
Have a great rest of the week.
You.
Yeah. And
you too.
If you're listening and watching, as always, like or subscribe, share the podcast. We really appreciate you guys joining us this week, and we will see you next week.
Have a great week.